In today's video, we are going to talk about starting a whole life insurance policy for a child. We're going to talk about reasons why people do this. Then we'll look at some numbers. And then lastly, we'll talk about how you can set this up if you're interested in this topic. Let's get on into it and have some fun talking about cash value life insurance. So we're going to look at an example for a child. We're going to look at a 3-year-old. And the reason why someone would be interested in getting a life insurance policy for a 3-year-old is not for the life insurance. Typically, they're interested in the cash value. And really, why someone would do this is to set that 3-year-old up for their future. So let's pretend that this is your daughter or granddaughter. You say, hey, I understand the benefits of whole life insurance. I want to build up cash value so she can use it for college. Maybe for a home purchase down the road, maybe just to save money with the benefits that come with the cash value, or maybe I'm looking at it very long term and I want her to be able to use it for retirement down the road. So why people do this, specifically get a whole life insurance policy for their children, is typically for the cash value. The reasons why is because the cash value is a safe place to put money, continues to grow over time, regardless of what's going on in the stock market or in the economy. Second, it's liquid. I can access it anytime I want without any penalty. And if I do access it, it keeps on compounding. It keeps earning interest. And then third, if we do everything right, it's tax-free, which is always nice. Now, how much should we pay into a policy? The answer to that question is any amount you'd like. However, we're going to look at 3 examples shortly. We're going to look at a policy for this 3-year-old and what it looks like if we pay $3,000 per year, $5,000 per year, or $10,000 per year. That'll be a big policy for a 3-year-old. Now, another question, how long should we fund the policy? Well, the answer to that question is as long as you'd like, or as short as you'd like. Everyone's different. Some people say, I'd like to be able to pay into this for as long as possible. Some say, I've got a lump sum of money. I just want to move it into a policy over the next 5 to 10 years. And then some say, some parents will do this, I want to fund this policy until my kid is 21 years old. And at that point in time, I want them to take over, but I want them to be committed just to a small amount. Because when I was 21, I wasn't making that much. So, how long do I want to be able to pay? Or how long are we going to look at funding a policy, I should say? In this example, we'll look at funding it for 30 years. But just a note, you can stop early. It can be after 2 years if you'd like, or you could pay forever. With the product we're going to look at, you can pay into it until you're 85 years old. So that's almost forever, especially when we're starting it for a 3-year-old. So let's take a look here. We'll start with the $3,000 per year example. So what we've got here is an illustration where we are just funding $3,000 per year, which would be how much if you pay it monthly? $250 per month. $250 per month for 12 months comes out to $3,000. So annual outlay represents the total amount you're paying per year. Total outlay tallies up all of your annual payments. So $3,000 times 10 years is how much? $30,000. And then you've got your cash value and death benefit. So there we go with the $3,000 per year example. Then we've got $5,000 per year, and then also $10,000 per year. And they all grow in a similar manner if we were to look at a rate of return here. But just one item to note, when you look at this on the board, you'll notice what's highlighted in yellow. So here, it's in the 5th year. Over here, it's between the 4th and 5th year, and same thing over here. This is our break-even point, which is the first year when your cash value is equal to or greater than your total payments. Because we are running a loss in the early years with a life insurance policy, which is the number one drawback. Now, the first year, we've got 92% of what we paid into the policy available in cash value. So let's see how these policies actually are performing. Over here, we've got cash value growth. What we're going to look at is how much you are getting from the insurance company. That's what we want to see here. So what we can do, first year, we just take the cash value and subtract it by the payment, which comes out to negative $290. Because you paid in 3, you've got $2,710, which means there's a loss of $290. That's why we're negative in the first year. Now the second year, what we would do is take the second year cash value minus the first year, and then minus our payment. We lost $123. But if we continue on, you'll notice it gets better and better as time passes. Third year, just about a wash, and then you're positive from that point. So this is what we are getting from the insurance company in dividends and interest every year. Call it the interest earned. Like that's how much we're getting from the insurance company, which is the financial institution in this case. We can look at the same thing with the 5K per year example. That one, positive a bit earlier on. And then the same thing with the $10,000 per year example. And again, all we're looking at here is how much we're getting from the insurance company in dividends and interest every year. Pretty simple. Let's continue on and answer some commonly asked questions here. So let's assume we pick the $10,000 per year option, or at least that's what you want to start with. What questions might you have? Here's the first one I would have. That illustration you just showed displayed $10,000 per year for 30 years. Is 30 years a long time? Yeah, it's a long time. Do you have to pay $10,000 per year every year forever? The answer is no, you don't, by any means. You could stop early and you can even pay less. So next, when I say you could even pay less, what's my minimum? Well, the answer to that question is the base premium. So let's look at where we can find the minimum premium on an illustration. And if you say, just tell me what it is, you'll see it's about $1,000, 10%. So here we've got 10K per year based on this illustration. There's your cash values. Let's look at the actual illustration here. There we go. And when we look at this guy, you'll notice this column is going to match what we just saw in green on the Excel sheet. So the first year, there's your 92%. There's your death benefit. Looks beautiful. So the question here is, what's my minimum? The answer to that question is up here, $1,000. Got a little bit that's going toward a term. The true minimum is going to come out to about $1,100 per year for a 3-year-old female. It'd actually be less than that. Very, very close to $1,000. So what that means is if I funded 10K per year and then life happened, so I planned to pay for 30, now I got to stop after 5, but I say I can still pay something, what's my minimum? You could easily just pay $1,000 per year. If you want to increase it later, you can. You can set it up to be very, very flexible, which is nice. But the answer to the question here, my minimum's $1,000. So I just want to add a point here. If you get a policy and it's set up where you have a plan to pay $10,000 per year, you're not locked into that. To illustrate, think of it this way. You want to set up a bank account for your child, for your daughter here. Your plan is to save $10,000 per year for them. If you can't put away $10,000 during any given year, are you going to be penalized for that? No, you're not. It's the same thing here. We can easily just fund a policy with less, then we can scale it back up to 10. It can be higher if we want to make up for lost time. There's a lot of flexibility, which is nice. Now, here's what some people like to do. Just over the years of speaking with parents and grandparents that want to start policies for their kids or grandchildren, a lot of times we might see a case where one says, hey, I want to fund a policy with $10,000 per year, but I eventually want to transfer this policy to my child when I feel that they're responsible, which probably isn't 18 years old. It's probably not even 21. Maybe it's between 25 and 30. But that's why we didn't put an age there. When the parent feels they are responsible, they want to give them this policy. Now, the child only has to pay the base premium of $1,000 per year. Think of it this way. If your mom and dad watching this video and you say, hey, we can fund $10K per year for our child, and we love the compounding in this policy. We want to be able to give it to them. And if they can keep on funding $10K per year, man, they're going to be a millionaire down the road. When you, mom and dad, were 25 years old, if you were given a policy and said, hey, put away $10K per year, and you don't really understand how it works, one, could you do it? And two, would you want to do it? Maybe not, even if your parents really encouraged you to do so. So my point is, if it's set up with a low minimum, what ends up happening here is it doesn't feel like a burden to their child. While we would like our children always to listen to us, they do not. Now, I don't have kids, so I can't say that, speak from experience, but I was a kid at one point, I still am, and I tried to always listen to my parents. Keyword being try. So let's wrap up by talking about how to set it up. So let's go through an exercise here. We'll have some fun. Let's say mom wants to get a policy for her daughter. So mom is 30 years old here. So mom, 30. Her daughter will be 3, just like the example we looked at. Okay. So with the policy, first we have what is called the policy owner. So we've got these two words here. Can a 3-year-old own a life insurance policy? No, they cannot. So what this means is mom would get the policy. Mom would be the owner, which means mom has complete control. She makes the payments, she sets the beneficiaries, she can access the cash value. The policy owner has full rights to that life insurance policy. Because she's getting the policy on her daughter would be considered the policy insured. Okay, here we go. Policy insured, daughter. So what does that mean? Well, that means if anything happens to the daughter, if she were to die, then the life insurance is paid out. So think of it, the term insured means that the life insurance benefit is paid out upon the insured's death. So mom's the owner, the insured is the daughter. Who's the beneficiary? Well, the owner sets that. What most parents will do is set the beneficiary up as themselves. Sometimes it's a trust if a family has that set up. If they plan on doing it later, then in most cases, they just set it up as themselves. So what mom would do is say, okay, nothing is going to happen to my daughter. At least I really hope not. But if anything did, I'll just make myself the beneficiary since this policy is meant to be for the family. Okay, now, what if mom's plan is to eventually transfer ownership to the daughter? Meaning we want to transfer this to the daughter when she is 25 years old or so. So we want to transfer from mom to daughter, which means mom's going to say, hey, I put all of this money into this policy for you. It's yours now. This is my gift to you since you're all grown up. And let's pretend she's 25 years old. So, an important item to note here. When you transfer ownership of a life insurance policy, the cash value, or a portion of the cash value, can be taxable. Specifically, the gains. So, what we look at here is how much was paid in. So, if mom, let's write it up here, paid $50,000 from day one up until age 25 of her daughter. That's how much she paid into the policy. And the cash value is valued at $80,000. So it's grew. Cash value, $80,000. That means everything above the $50K you paid in is considered a gain. So now we've got a gain. What color you like? Purple? Let's put gain in purple. Gain of $30,000. So that would now be taxable to the daughter if she assumes ownership of that policy. Now, not everybody likes that because they get into cash value life insurance for the tax benefits. And they say, hey, if I'm going to transfer it down the road, that I feel like I'm defeating the purpose here. Is there a way to work around that? So you could just never transfer it, but that doesn't really work for everyone. What you could do is set the policy up where it is owned by a trust, either initially, or we can transfer ownership to a trust before there's a gain on the policy. If you said, no, I don't want a trust, I just want to transfer it to them cleanly, what you could do is transfer it to them, one, before there's a gain, or two, if there is a gain, what we sometimes can do is gift some of that gain. So the annual gift tax exclusion is what? Just for the annual gift, I believe it's around between $15,000 or $16,000 right now. Down the road, it's probably going to be higher. So you can offset some of that by gifting it, which is nice. And then if I do have some taxes due, what I could do is take a withdrawal or a loan against the policy to pay those taxes. That's a strategy. Another idea that someone just threw at us was, hey, can I just pay the minimum initially and then backfill the policy later with a big lump sum? But right before I do that, I'll transfer ownership to prevent a gain from occurring. Like, yeah, you could do that. The drawback is you give up some time because when money gets into the policy, it starts to earn dividends and interest. So the sooner we get it in, the more money we'll have long term. So it's something to consider, but we've got to weigh the pros and cons. Anyway, I hope that made sense. We always like talking about that topic. With that said, if you have any questions, please feel free to leave them below in the comments. And as always, I hope this helps.